Hi, welcome to our channel. Today we will present to you one of the powerful indicators and most profitable, with many of examples. If you want more videos, make subscribe and turn on notification bell to receive everything new. This indicator compatible with all stock, crypto, and forex market. Please keep watching to end to achieve all the benefit from this video. You will learn in this video what is the RSI indicator and how to use it with 4 different strategies to growth your risk to reward ratio and make your trade more profitable. The Relative Strength Index RSI is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. So the strategies that we explain today. Number 1. Overbought, oversold. Traditional interpretation and usage of the RSI are that values of 70 or above indicate that a security is becoming overbought or overvalued, and may be primed for a trend reversal or corrective pullback in price. An RSI reading of 30 or below indicates an oversold or undervalued condition. As you can see in the following chart, during a downtrend, the RSI would peak near the 50% level rather than 70%, which could be used by investors to more reliably signal bearish conditions. Many investors will apply a horizontal trend line between 30% and 70% levels when a strong trend is in place to better identify extremes. Modifying overbought and oversold levels. When the price of a stock or asset is in a long-term horizontal channel is usually unnecessary. A related concept to using overbought or oversold levels appropriate to the trend is to focus on trade signals and techniques that conform to the trend. In other words, using bullish signals when the price is in a bullish trend and bearish signals when a stock is in a bearish trend will help to avoid the many false alarms that the RSI can generate. Number 2. Trend strategy. During trends, the RSI readings may fall into a band or range. During an uptrend, the RSI trends to stay above 30 and should frequently hit 70. During a downtrend, it is rare to see the RSI exceed 70, and the indicator frequently hits 30 or below. These guidelines can help determine trend strength and spot potential reversals. For example, if the RSI can't reach 70 on a number of consecutive price swings during an uptrend, but then drops below 30, the trend has weakened and could be reversing lower. The opposite is true for a downtrend. If the downtrend is unable to reach 30 or below and then rallies above 70, that downtrend has weakened and could be reversing to the upside. Trend lines and moving averages are helpful tools to include when using the RSI in this way. Number 3. RSI divergence. A bullish divergence occurs when the RSI creates an oversold reading followed by a higher low that matches correspondingly lower lows in the price. This indicates rising bullish momentum, and a break above oversold territory could be used to trigger a new long position. As you can see in the following chart, a bullish divergence was identified when the RSI formed higher lows as the price formed lower lows. This was a valid signal. A bearish divergence occurs when the RSI creates an overbought reading followed by a lower high that matches corresponding higher highs on the price. But divergences can be rare when a stock is in a stable long-term trend. Using flexible oversold or overbought readings will help identify more potential signals. Number 4. RSI swing rejections. Another trading technique examines the RSI's behavior when it is re-emerging from overbought or oversold territory. This signal is called a bullish swing rejection and has 4 parts. 1. The RSI falls into oversold territory. 2. The RSI crosses back above 30%. 3. The RSI forms another dip without crossing back into oversold territory. 4. The RSI then breaks its most recent high. As you can see in the following chart, the RSI indicator was oversold, broke up through 30%, and formed the rejection low that triggered the signal when it bounced higher. Using the RSI in this way is very similar to drawing trend lines on a price chart. A bearish version of the swing rejection signal that looks like a mirror image of the bullish version. A bearish swing rejection also has 4 parts. 1. The RSI rises into overbought territory. 2. The RSI crosses back below 70%. 3. The RSI forms another high without crossing back into overbought territory. 4. The RSI then breaks its most recent low. The following chart illustrates the bearish swing rejection signal. As with most trading techniques, this signal will be most reliable when it conforms to the prevailing long-term trend. Bearish signals during downward trends are less likely to generate false alarms. The limitations of the RSI. It compares bullish and bearish price momentum and displays the results in an oscillator that can be placed beneath a price chart. Like most technical indicators, its signals are most reliable when they conform to the long-term trend. Since the indicator displays momentum, it can stay overbought or oversold for a long time when an asset has significant momentum in either direction. Therefore, the RSI is most useful in an oscillating market where the asset price is alternating between bullish and bearish movements. As usual, finally, we advise you 2 things. Number 1. Use a fixed ratio for all your trade like 2:1 or 1.5:1 risk-reward ratio, and never ever playing with your risk management plan. Second thing. We advise you to select one of the other indicators like moving average or VWAP to increase the success ratio for your order, where to start and where to stop, and show where is the exact trend for the chart. Please keep watching our channel, because we will put many of other indicators and strategy help you to grow your trading account. Thank you for watching.